And welcome to Recovery Report Live. I'm Dan Odess, president of GlobalPro, where we manage risk to recovery, and we have managed more than $1 billion in that recovery. We're here live from the Griffin studio to talk about important issues today. How to buy insurance in a hard market during tough economic times. It's a topic I think is important to our community, our business owners, our community associations. So let's dive into this topic. How to buy insurance in a hard market during tough economic times. It's a mouthful, and it's an issue that I know a lot of associations particularly are dealing with in some of the markets in which we operate. Primarily, I would say in the coastal regions where we've seen a pullback on opportunities or insurers that are willing to actually sell insurance in those markets for various different reasons. Some we believe, some we question, some we downright know are not even true. But it's a combination of issues that is impacting your ability to buy insurance, whether you're a community association or a business owner. You are feeling it in your pocket. But you may not realize you're going to feel it even more if you experience a loss, because we are paying more for less coverage. It's a simple fact. It's something we've talked a lot about on the show. I've talked about the issues and things to look for, but I wanted to, in this episode, break down some of the things that you should be looking for and asking about, and how, in which order you should be doing these things when you're placing insurance. So let's dive into it. Let's talk about how to buy insurance in a hard market during tough economic times. I'm going to start off with the top. Most people, they have a budget in mind, particularly for associations. You're out there creating these budgets on an annual basis with your property managers, sitting down, doing your budgets. Budgets primarily focus on what money do we have coming in, and what can we spend. And you reach out to your broker and you ask them for a price to put in there. Now, more commonly today than ever before in coastal areas, there is reserves set aside not only for the cost of insurance, but also for deductibles. But what's not being reserved for are the little hidden limitations that are being added every single day to our policies. Again, we are paying more for less insurance today than ever before. So as we get in the later segment, we'll talk about those issues, those little sneaky little supplements and exclusions that have found their way into our policies that are costing us more. And while you may be reserving for the cost of the insurance and this expected deductible, which are now commonly about 5%, 5% is what we're seeing because of the increased cost of the actual insurance. I would say about 5 years ago, it was 1 in 3%. Now, I would say it's more common to have jumped the 3 to the 5, and we're seeing 5%. I even have associations considering 10% deductibles. For business owners, this is worrisome as well. You need to look very, very closely at it. But it's not just about the hurricane deductible, which I'm harping on. It's also the issues regarding deductibles for other types of claims, particularly water losses, where they're increasing the deductible from your typical all other perils deductible, which may be $2,500, maybe $10,000 on the high side, on average about $5,000. They're giving you a $25,000 deductible, if not more on that. And then there's sublimits. But before we jump ahead and start talking about those things, let's take this in the correct order in operations. Now, I mentioned that most associations will do financial audits and they will budget for the cost of the insurance. However, while that is important to your budgets, when placing insurance, that comes second. The cost is second. What we want to do is kind of treat this process like buying a car. When you go in to buy a car, anyone has ever bought a car, goes into the dealership, you ask for the most loaded vehicle of the version in which you want, you start there. You want to understand what the most loaded version of it's going to cost you, and then you figure out what you don't need, and then you start to negotiate on price. And the reason for it is that typically if you go in there for the most loaded vehicle, you're going to start to get some sort of discounts on that price in a typical market. Now, I know nowadays people are paying sticker, if not over sticker. I'm talking about the typical process by which we are used to buying cars, the typical economic times. those typical economic times, we would go in, we would find the vehicle that we would want, right? The one that we would want with all the bells and whistles, and we would negotiate a fair price on that. And then if that was not within our budget, then we would start to take things off, options off, and try to get to a vehicle that fits now within our budget that affords us maybe even more of a discount than you would otherwise be getting on the highly loaded vehicle that you initially started out this negotiation process. Now, this is how I would typically negotiate a car and what I've done for years. And I learned from my father how to do this, and it has worked for me throughout the years in buying dozens of different vehicles, whether for me personally in the business. It's definitely a good practice, again, in a typical market. So when it comes to insurance, we want all the bells and whistles. We want to know what the best possible policy out there that is available to us. And then we want to figure out what we can eliminate or reduce in order to fit within our budget. So, for instance, one of the things we talked about was the hurricane deductible, right? We want to know what the cost of the lowest deductible, the lowest out-of-pocket expenses, if in the event that we had a loss, what would that cost me? Also, we want one that has no sublimits or the least amount of sublimits with the best rated insurer, right? We want to look at things like that. Well, to get to that point, we need to figure out what we actually need. So that's step one. So step one in buying insurance is figuring out what you actually need, not the price. So start with what you need. Now, when it comes to community associations, that typically starts with an insurance appraisal. Insurance appraisals, if they're not updated, can be an issue, particularly in today's market where we have this crazy cost of construction issue and real estate values that are all over the place. We've seen them skyrocket in some markets. We're seeing some leveling off, if not some dips in other markets currently. So we're in tough economic times. We're in a hard insurance market. So it really depends on where you're located as to whether or not the appraisal you got last year or 3 years ago is even relevant to today. And unfortunately, these appraisals are expensive and can cost money to update and renew. So a typical practice for most brokers or insurance companies is to ask for an appraisal that's within the last 3 years. But unfortunately, in the last 3 years, we all know that things have dramatically changed. And as I gave the analogy to buying a car prices have dramatically changed. The whole negotiating of buying a car has completely changed. But the process of buying insurance hasn't changed in what is the priority. And the priority is trying to figure out what you need. So for community associations, you want an updated appraisal, an appraisal that reflects actually what you're insuring. Now, the problem with these appraisals is that at times there's a lack of coordination between the appraisal and what you actually need to insure, particularly for associations that are a makeup of many associations. You have an association for multiple towers, and then you have a master's association. And then you want to further complicate that by putting a commercial operator in there, like a hotel. And this is becoming more commonplace, particularly in the Florida markets, throughout Florida. I would say Central Florida and even some of the West Coast and East Coast. South Florida, we've seen it over the years, but I will say that it is definitely becoming commonplace in the Florida market. Now, Texas is starting to see some of this as well, where they have commercial, actual tenanted space on the ground floor, and then you have your residential space above it. And so you're having a commercial operator in there, and it's very important to understand where your liabilities begin and end. Now, there is something you can ask for from legal counsel for your association attorney. It's called a matrix. And the matrix should be an exhaustive breakdown of your bylaws and the laws in the state in which your association resides. So take Florida, for instance. They're going to look at your bylaws, how the property is actually, the rights and where ownership begins and ends between both community association as well as commercial operators or unit owners. It's also going to take into effect Florida statutes 718, 711, and look at your insurable interest and your extension of your liabilities, because it's not only just your insurable interest, but also your potential liabilities. Because there are some situations where you can't get insurance to cover you for certain things, but you may still have certain exposures or liabilities, right? So they're one and the same, but categorically sometimes separated. Now, that may be a confusing statement, The reality of it is like, for instance, like fences, are they attached to the building or not? Even though they're not attached to the building and not covered under your property insurance, if someone is hurt because a fence falls on them, there may be a liability issue. So again, that's a good example of what I'm trying to explain here. So appraisal, legal counsel can give you a matrix. You need to look into the operations of your building. Do you have a robotic garage? Is there something unique about your building? The elevators, the way in which people ingress, egress from the property. Those things need to be taken into consideration when dealing with this. Are you against the beach in a public space? And what is the shared responsibility in those easements or in that public space? For instance, in some areas, you have public walkways that, while they are the responsibility of the association to maintain, the public has a right-of-way to access them. So again, something important to understand, and from an insurance perspective, can certainly impact your rating and what you need to insure. So make sure you get into those things. Make sure your appraisals are updated. Make sure that you have a matrix. I highly recommend a matrix, particularly today in the hard market. A good example of where a matrix really helped out an association that we helped place insurance, and we have helped over 1,000 community associations and business owners place insurance. And one of the first things I do is I ask for this matrix, right? And I'm asking for the bylaws. I'm also asking for the building drawings, right? If you don't have the building drawings and you don't have the bylaws, you certainly can't create a matrix. And if you don't have a good understanding of the operations of the property and some of the uniqueness that may be at your property that may impact rates, it gets very confusing and very difficult to place the insurance. All right, so from the top, right, we want to make sure we have updated appraisals. We want to make sure we have matrix in hand. Okay, we want to see building drawings and bylaws. Those are 4 very, very good things to have in hand when trying to figure out what insurance I need. Now, some might say, well, Dan, what about the loss runs? That comes next, okay? So let's focus on those 4 things. Make sure that we have updated appraisals. Make sure we have an updated matrix that actually properly reflects your building drawings, operations, as well as what actually is in your property, and identifies any sort of unique issue or something that needs to be insured at your property. It's really, really important. And then from there, you can determine what to do next. Now, for business owners, it's a little bit different, because I think the failure when placing insurance for business owners is heavily focused on operations, but also those lease agreements, those pesky lease agreements that are often legacy lease agreements that, unfortunately, while they do auto-renew or are 5-year, 10-year actual contracts, they don't keep up with changes in the Florida statutes with regards to, or any laws and changes in basic business operations and also insurance law. And because they don't keep up with it, you might not actually be properly insuring your business, okay, and the property, if your broker isn't taking into consideration these things and the changes that may be occurring outside of your business and the operations. And it may have been just good enough to get that renewal, to get it out, the price barely changed or it changed, whatever it is, and simply focus on what they can get you, but are not actually looking at possible changes in the market and how that may impact you and your insurable interest in it. And these legacy lease agreements, particularly those that existed before the pandemic, let's say 2019 and before, I can tell you right now, there are going to be issues, particularly in the Florida and Texas market, and you can contact our team. We'll walk you through some of those issues. There are quite a few of them, so I'm not going to bore everyone right now with them. The second part of that is your income. And income coverage became a big focus and continues to be because of the fallout from the pandemic and the erroneous position that these insurers are taking, even where there's no exclusion for virus or pandemic or anything like that. They're saying that there's no coverage for it. They couldn't possibly anticipate it. Well, ironically, they had lobbied for these forms to be available to them, and they knew they were available to them. So if they didn't include them, then they very well obviously could have anticipated it, but chose not to exclude for that particular type of coverage. Which brings you to this issue of coverage and what do I actually need, which is the first part of figuring out what insurance I'm going to be buying, actually going to bind and pay for, right? So that first act of what do I need? And if as I mentioned with regards to the community association, updating those appraisals because of the dramatic changes in the market, we saw dramatic shifts and changes in business operations and their financials. Some skyrocketed during the pandemic. Some found their way shortly after we started kind of getting back to business as usual, and international flights opened up and tourism started all over again, particularly in some of your vacation areas such as the South Florida market, Central Florida, Texas, coastal areas, our tri-state New York, New Jersey area. So you've had shifts in the economy, and then you had shortages in supply of food and increased costs of fuel, which is feeding possibly expenses, which is impacting your net profit, which you may only be insuring, right? So there's many different types of income coverages, and you need to make sure that the kind of income coverage you have today is actually going to insure you and protect you in the event of a loss tomorrow. So, or something may happen the day you place the insurance, who knows? But the real important issue is to look to making sure that you have a proper assessment of what coverages you need. And one of the things that came up for a lot of our business owners, some restaurant owners, is that they had orders that reoccurred for certain food or items. And unfortunately, through trends and changes in the market or scarcity of one thing versus another, you may be getting product or things that you don't need, or there may be certain delays in the delivery of those certain things. And when and where do you actually, where is your liability, and when does your insurance kick in, and where are you responsible for those items? If they don't get delivered and you can't complete your operations, if the moment they get loaded onto the truck at the distribution center and sent to you, you're insuring them, you need to look at your contracts with your vendors and truly understand it. It's somewhat like, as I mentioned earlier in the show, about community associations looking at bylaws and the strict coordination between a commercial operator and a community association, or a community association made up of several other community associations. It's somewhat similar to that. You need to get into the weeds and almost create a matrix of your liabilities and exposures as it may directly impact your financial situation. And how are you going to insure against potential loss that may have occurred, or let's say shortages or issues in your supply chain. You can get coverage in certain sort of operations and types of industries for that type of loss or issue that may impact financially your business. So those are some really important issues and some things you need to understand. Most brokers and agents don't come out to your property, do not come out to your business. They don't do a walkthrough and understanding of what's going on. If you made any sort of upgrades to your property, new fire suppression systems, if you've changed the ingress egress of your restaurant because of the use of the outdoor space, how are you insuring all of that? I'm sure it costs you money to build that outdoor space. And in some cities and jurisdictions, they're allowing restaurants to continue to operate in this public space, on sidewalks, on street curbs. Have you taken this into consideration in your insurance? Are you properly protected in the event that something were to occur? Or let's say the city decides one day that they no longer want you to be able to operate that way. Okay, and suddenly they come in with civil authority and shut you down and remove you from the sidewalks in the public right of way, which has led to a growth in your business or a stabilization in your business because there's certain other restrictions with regards to the interior use of your space or something else that may have occurred. So again, something to consider, something to think about. All right, so now we talked about how do you figure out what you need. I broke it down for community associations and I broke it down for business owners. And I hope it wasn't confusing. I know I hit a lot of things quite quickly there. Again, this is to whet your appetite, to encourage you to think differently, to look a little bit closer at these issues. And if there's any way we can help you, let us know. We are doing more of this today than ever before. This really honestly started, I would go date back to about 2015, where we started seeing a lot of community associations and business owners really engage us early on, prior to them having losses, and getting our feedback as to what insurance they should be buying and how they should be buying and what they should be dealing with. So after you figure out what you need, and you now logically need to move into cost, okay? Next comes the price. Now that you know what you need, let's start talking about the cost of it. By talking about the cost of it, there's some fees that you need to be aware of, right? The first one that comes up, and a lot of times you'll hear your broker talk about your rating. Most of you, it just kind of goes over your head. You don't even know what they're actually even talking about, how they even calculated, why your rating is one thing versus someone else. You know, one business that's on the beach versus the business that's across the street may be a totally different rating. You may be a corner operation versus a inner operation in a strip mall, different type of rating. You may be in a high-rise building. You may be a garden-style building. You're always going to be getting different kinds of ratings, but consistency in those ratings is what's key here. But you as a consumer are only looking at what you have. But has your rating changed? And if it has changed, let's look back at where the rating is today versus historically in the past and see if there's been a reasonable change in that rating and the type of rating that you're getting and what they're doing. Start asking about that. Because if they're talking about it today and you're a new board member and you did not have access or were not part of placing insurance in the past, now's a good time to start talking to your broker about prior ratings and how the rating has changed and what goes into actually establishing a rating. And business owners do the same thing, right? Maybe you're considering moving from one broker to another. Is your rating changing the same? Is staying the same, or is it changing from one broker to another, one insurance company to another? Sometimes I've even seen where you go from one broker to another and you stay with the same insurance company and the rating still changed, even during the same policy period. So you need to pay particular close attention to that. Some of the things they do take into consideration, as I kind of alluded to, is proximity to water. It's a big one. It's a big one that impacts a lot of this. There's high wind zones, there's flood areas, there's many different types of things that go into those ratings, but make sure you're aware of it. And also join industry organizations and start talking to others within them about your rating. Find those within the organizations, like a great one is Community Association Institute. We're very involved there. Start talking to other Community Association Institute members about the types of ratings and the policies that they're placing and obtaining and the rates at which they're paying for this insurance. And I think you'll get a more clear idea about this rating system. Now, this brings me to the second part, which is insurance company ratings, right? Where we all are conditioned and at times obligated to want the best possible rating for our insurance company. But I can tell you that today, the insurance company rating means less than ever before. Why? Because the reason why you're buying insurance is to protect your risk, right? It's the transfer of risk. It's that in the event that something were to happen, that they're going to be there to pay you. And they have the financial ability to do that, to make good on that promise. Unfortunately, though, and as mentioned in prior episodes, we have a massive increase in dissatisfaction amongst consumers with regards to claim payments. Okay? So if I'm transferring risk by paying a premium for them to be there to pay me, and if more so today than ever before, insurance companies are falling down on their obligation to pay on that promise, then what do I really care that they're an A+ rated insurer? If they have a reputation today of not paying, and there's a lot less consumer reporting on these issues, on claim payments, on dissatisfaction. Now I see the reports. We've talked about the reports. Value Penguin is one I can bring up right now. where it talks about consumer feedback, but there's a lack of evidence or statistics on which insurers are actually the ones doing this or not actually paying. Now, when we've dissected this information and found some of those statistics, what you'll find is that your highest rated insurers that are getting the bounty of the opportunity because they are offering the most attractive rates are oftentimes not the ones paying on that promise. So while they have the financial ability to pay you, they're not most often, right? So that's what we're seeing a lot of. So insurance ratings are important when it comes to properties. If you have a mortgage, property owners that have mortgages, or commercial lenders, they're going to require you to buy insurance from a highly rated insurer, and it's very important. But again, I question the importance of this rating in today's market, where more insurers, a lot of insurers with that high financial rating are actually not, in fact, paying on that promise. So there's I think there's an issue in the market, and we hope to do our part in correcting that by holding these insurance companies responsible for this promise to pay, right? So understand what the insurance rating is, understand what your obligations are, understand what the minimum financial rating is, but start asking questions about what that insurer is going to do for you and how they're going to do it for you and the broker's experience with this insurer when they go to pay. Because I can think of one insurer, and I'm not going to name names here on this episode, but I can think of one insurer that had a tremendous book of business here in Florida following the 2017 storm season. They insured a tremendous amount of properties. They offered incredible rates. They had a great product that had this robust amount of coverage. And we actually have testimony from the corporate representative who cannot think of a single claim it paid after the 2017 storm season, right? So while they were highly rated, sold a great product at a great rate, they did not pay on that promise. So for a consumer, I struggle with the idea that it matters as much as some of the other things, but it definitely is a consideration. It's important to know that your insurer has the financial ability to pay its claims, but the emphasis on it and how it's promoted by some brokers sometimes, to me, misses the mark. And I think as consumers, we need to wise up to this and start asking questions about what they're going to do for you in the event that something were to occur. Broker fees, I've talked about this in prior episodes, and we're breaking down the fees and costs, right? And we're trying to figure out what it's going to cost me now. We first started out this episode talking about what I need. Now we're talking about the cost of it. These are all things that go into the cost of the insurance. A higher rated, financially stable insurer typically is going to cost you more money to buy that insurance product, right? So another thing to consider is broker fees, all right? Broker fees now should reflect the product they're selling, not so much a linear increase in cost, right? It shouldn't, just because you're paying more for insurance doesn't mean you should be paying more for your broker. You need to look at what product they're selling. Right? If they're selling you less insurance for more money, why is their broker fees going up? It doesn't make sense to me. There should not be a linear connection between the amount you pay for insurance and the amount you pay your broker, or the insurance company pays your broker on your behalf, right? There should be consideration for how much insurance they're actually selling you. What are you getting coverage for? Which brings me to my next point, supplements. All right. More so today than ever before, while you have a total amount of insurance, or a total insurable value, TIV, which is an acronym you'll see in some commercial policies for both business owners and community associations. The reality, though, is that if you actually were to look into these forms that are in these policies today, building on my point that you're paying more for insurance for less coverage, while yes, you've complied with your obligation, your lien holder or your mortgage company's obligations to insure to the full amount of the property based on appraisal, and maybe that's the obligation under the statutes in your state in which your property resides or sits. The issue though is that in the event of certain types of losses, you will never reach that limit. You will reach and most often exceed a sublimit. So you're not actually insuring to the total insurable value of your property. You're insuring to a sublimit of that. So let's, for instance, you have a $100 million policy on a high-rise property that's in a coastal area. You're paying a ton of money for insurance. The interesting thing is that hurricane damage is no longer hurricanes, and there will be a sublimit in there for things like wind-driven rain, which in 2017, as we mentioned many times on this show, it was construed to limit, if not exclude, coverage for water in buildings, where an insurance company believed there was no wind-created opening, even though there was no other prior record of any sort of water getting into your building, or if there was, it was through one or two windows, and now suddenly you have 100 units damaged. And anyone would agree that you have coverage for that, and that was a unique event, a hurricane that occurred, which caused damage in the ingesting of the insulation around the windows, whether it's the gaskets or the cracking of the stucco that created an opening, allowed the water to get in. Those things would be covered, but insurance companies are taking that opportunity to limit, if not exclude it, and claim that suddenly hurricane damage was something other than that, and wind-driven rain, even though wind drives rain and wind is in a hurricane, and wind and rain are both a factor in considering hurricanes, and how you can distinguish between a thunderstorm and a hurricane is because of high wind speeds, and typically a lot of rain occur at the same time. So it's a convoluted situation, but it further highlights this issue. Another one is sewer backups. We've mentioned this again on this show. These are sublimits that are limiting your recoveries despite your compliance with laws and lien holder obligations. So again, paying more for less coverage. That's what we're doing here. So you need to take into consideration what you're paying for, how you're paying for it, and how much you're going to pay for it. And I think we did a good job here today breaking down some of the things. I want to give you a quick summary of these issues because I know I've talked a lot about it. We're going on about 30 minutes here in this episode. I think it's an important issue. And you know, right from the top, how to buy insurance in a hard insurance market in tough economic times. You want to first focus on how do you figure out what you need. You want to then talk about the cost, the price of it, and you want to break down the fees and sublimits within there to really figure out what you're buying and how much you're actually paying for it, so you can compare it to other opportunities, other insurance that may be proposed to you by various different brokers. Take your time, slow down, gather the information. But gather the information methodically, work through the scenarios, take your time through this. Don't rush in that 30, 60-day window that your brokers are often giving you right before the renewal. You should be doing this on an annualized basis with your association or your fellow business owners and understanding what it is. Start asking your other business owners, start asking your other community association managers and board members what they're getting at what price and seeing how it stacks up to the insurance that you're buying. Well, I want to thank everyone for joining us this week on the Recovery Report Live. I hope that was great information, actionable information you can use. And if you haven't already, hit the subscribe button, like us and follow us on all the social media. We'll be right here in the Griffin studio on the Recovery Report Live, same place, same time next week, 11 o'clock Eastern Standard Time, providing you information you can use. So again, hit the subscribe button, like us and follow us. We want to continue to make sure that we're delivering information you can use, and the best way to get that information is to make sure that you are locked in with us every single week right here, 11 o'clock Eastern Standard Time. Again, Thank you so much for joining us this week on the Recovery Report Live.